Imagine this. A secretive setup designed specifically to build one of the most ambitious projects in American history, the Transcontinental Railroad, but with a hidden agenda.
Right.
Its real purpose. Well, it was meant to become a money-making machine for the insiders running it.
Mm.
And this scheme, it was really unlike anything seen before on American soil. It promised fortunes without taking on the actual risks. The risks of building and running a railroad across a continent.
A revolutionary concept, in a way.
Absolutely. And the wild part, at the time it was conceived and even executed, it wasn't strictly illegal.
That's key.
Even though looking back now, it feels like it absolutely should have been. We're talking about figures like Thomas Durant, the driving force behind the Union Pacific Railroad, and, well, a financial maneuver that would just explode into one of the most infamous scandals of the 19th century.
That really paints a powerful picture of the Credit Mobilier scandal.
Mm-hmm.
It's such a story of Gilded Age ambition, wrapped up in this financial engineering that just pushed all the boundaries of law and ethics at the time.
Yeah.
And as our sources highlight, this wasn't some minor issue. It involved millions of dollars. I mean, a staggering sum for that era.
Huge money.
And it implicated dozens of prominent government figures. It reached deep into the halls of Congress and even beyond.
It really cuts right to the heart of that explosive period in American history, doesn't it?
It does.
So our mission in this deep dive is to really dig into the sources you've provided. We've got historical articles, legal analyses, accounts from the time.
A good mix.
Yeah, and we want to understand the mechanics of this Credit Mobilier scheme. How did the government try to respond as it all unfolded? What about the complicated legal battles? Because they went all the way to the Supreme Court.
Right, several times.
And ultimately, what does this whole saga tell us about, the intersection of corruption, business, and the evolving role of law during this era of unprecedented American expansion?
Absolutely. It's a fascinating case study. It shows how a monumental national undertaking, something intended for the public good, could get tangled up with these sophisticated financial manipulations.
Uh-huh.
And it forced the legal system to confront issues it just hadn't really anticipated before.
Okay, so let's set the scene then. We're talking mid-19th century America. The idea of a transcontinental railroad, it wasn't just an engineering marvel, right? It was seen as a national imperative.
Absolutely essential.
Connecting the coasts was, vital for unity, for commerce, for destiny, really. And because it was so important publicly, the government wasn't just, cheering from the sidelines.
No, they were major partners.
Major partners. They provided vast land grants along the route, substantial financial loans to the companies doing the work.
Huge incentives.
So the success of this project and, I guess, the financial health of the railroads themselves was directly tied to the public interest and, of course, the government's own balance sheet.
Right. And that deep government involvement, that massive flow of public money and resources, that's what created the opportunity. Our sources introduce us to Credit Mobilier of America. Now, this wasn't just any construction company. It was specifically chartered with one primary goal: build the eastern section of the Transcontinental Railroad. That's the part the Union Pacific Railroad was tackling.
Okay, so on the surface, hiring a construction company seems pretty standard.
It does. But the crucial detail, the sort of corrupting detail, lay in who controlled Credit Mobilier.
Okay, and this is where Thomas Durant and the other insiders really come into play, isn't it? They weren't just content with running the Union Pacific and, maybe profiting years down the line if it was successful. They wanted to cash in immediately, right during the construction phase itself.
Precisely. The core business model of Credit Mobilier, as the sources describe it, was breathtaking in its simplicity and its audacity.
Okay.
Durant and his associates, they were key figures, directors, major shareholders in both the Union Pacific Railroad and Credit Mobilier simultaneously.
Both hats. So because they controlled the railroad,
they could ensure that the Union Pacific awarded these incredibly lucrative construction contracts to Credit Mobilier,
a company they also controlled.
Yeah, exactly.
So the people who needed the building done were also the people doing the building. They were effectively just hiring themselves.
That's it. And paying themselves very, very handsomely. The analysis in the sources shows they would award contracts to Credit Mobilier for the construction work, but at heavily inflated prices.
Inflated prices, okay.
So this meant the money that was loaned and granted by the government, plus any funds raised by Union Pacific itself, flowed straight into Credit Mobilier's coffers.
Uh-huh.
and at a rate far higher than the actual cost of the work being done.
And that difference, that inflated amount, that was just pure profit for the Credit Mobilier shareholders.
Yes.
Who were, conveniently, the same insiders running the Union Pacific.
That's precisely the money-making machine concept the sources talk about.
Yeah.
This structure, it guaranteed they would garner profits from railroad construction itself.
Right, from the building, not the running.
Exactly. They were designed to realize a fortune from the railroad. Not by waiting, not by dealing with the complexities of operations, freight rates, competition, all that messy stuff that comes after construction.
Yeah.
No, they just managed the construction process and paid themselves these inflated sums for it.
So this arrangement deliberately shielded them from the high-stake risks, as the source puts it, the risks inherent in the actual railroad project.
Absolutely. Things like, would the completed railroad even generate enough revenue to be sustainable? What about the operational challenges in those harsh environments it crossed? All those were risks for the Union Pacific entity, the one left holding the railroad.
But not for Credit Mobilier and its shareholders.
Not for them. Their goal was profit during construction. It was completely detached from the long-term success or, frankly, failure of the railroad itself.
That's such a crucial distinction, profiting from the building process, not the operating process. And the sources, they really emphasize the secrecy involved here.
Oh, completely.
This company was secretive and utterly opaque to the reporters who eventually tried to discover its workings.
They weren't exactly putting out press releases about their ingenious dual control structure.
Yeah, definitely not. The lack of transparency was fundamental to how it operated. It allowed this insider dealing to happen completely away from public view, and at least initially, away from governmental scrutiny.
Okay.
And it's really worth repeating that crucial point from the source. This arrangement wasn't illegal at the time, though it should have been.
Right. That's mind-boggling.
It highlights how novel, how unprecedented this kind of financial engineering was. The legal frameworks back then, mid-19th century, they just hadn't contemplated such complex, interlocking corporate structures, especially not ones designed for insider enrichment on a project this massive and one heavily backed by public funds.
The laws just hadn't caught up.
Exactly. They hadn't caught up to this new form of potential corruption. So, okay, this machine is running, it's making insiders rich off these construction payments, but eventually concerns started to bubble up. What was the core problem from the government's perspective once they started paying attention?
Well, the most immediate and pressing concern, the thing that really motivated the government to act, was this growing worry about the financial health of the Pacific Railroads themselves.
Okay.
Critics could see that the directors and insiders weren't just building a railroad. They were, as the sources say, paying high dividends to themselves and shareholders and siphoning off money to their own corporations.
And that siphoning was happening largely through those inflated construction contracts to Credit Mobilier.
Primarily, yes. That was the main vehicle.
Okay. And what was the consequence of this siphoning? What were people worried about?
The consequence, as foreseen by worried government officials and critics, was pretty dire. They feared this siphoning would leave the railroads in such a poor financial condition that they would not be able to repay their debt to the government when it became due.
Ah, the loans.
Exactly. Remember, the government had loaned these companies millions in bonds, provided huge land grants. If the companies were just extracting all the wealth during the construction phase via Credit Mobilier,
then there wouldn't be enough left later to pay back those massive government loans.
Precisely. The necessary financial reserves, the earning capacity, it just wouldn't be there. The public's investment was seriously at risk.
Okay, so it wasn't just abstract outrage over the corruption itself, though I'm sure there was plenty of that. It was a very concrete threat to the government's own finances and the public trust placed in this whole national project.
Yes, very much so.
And that's what finally spurred Congress to act.
Yes. In response to these mounting concerns, Congress passed the Credit Mobilier Act of 1873. However,
there's always a however.
There is. As the source notes, this act was, well, awkwardly designed. It sent mixed signals about how it intended to solve the problem. And this legislative confusion, it immediately became fodder for legal challenges.
Awkwardly designed? How so? What did it actually do or try to do?
Well, think of it as kind of a hesitant first step. Section 1 of the Act gave the Secretary of the Treasury the authority to withhold all payments that the government owed the railroads for services they provided.
Okay, like carrying mail, troops, government freight.
Exactly. The basic idea was if you owe us money, we'll just hold on to the money we owe you as a way to offset the interest accumulating on your debt.
That sounds like a pretty direct approach. Use what we owe you to cover what you owe us. Simple enough, right? But then Section 2 complicated things.
Massively complicated things. Section 2 of the Act then provided a mechanism, a procedure, for the railroads to actually retrieve what money the government ultimately owed them from those withheld funds.
Wait, what? So the government could hold all the money under Section 1?
Yes.
But then the railroad could start a process under Section 2 to get a lot of it back, specifically the part that wasn't applicable to the debt repayment under the original, more limited terms.
Exactly. It created this messy, unclear system. Was the government really trying to seize funds to cover the debt interest, or was it just setting up some kind of complicated accounting process?
Yeah, that sounds confusing.
And this fundamental ambiguity in the law itself, it directly led to the legal challenges.
So it wasn't a clear command to seize funds to cover the principal debt or even all the interest that was due. It was this convoluted withholding mechanism, but with an escape hatch kind of built right in.
Pretty much, yeah.
And this immediately went to court. The railroads weren't just going to sit back.
Absolutely not. They weren't going to just accept the government potentially withholding funds without a fight. This legislative ambiguity really set the stage for these big legal battles, leading directly to the Supreme Court.
Okay.
And one of the very first cases to test this 1873 Act was United States v. Union Pacific Railroad Company. It reached the Supreme Court in 1875.
So this is the initial legal test. Could the government actually use the money it owed the railroad as leverage for debt repayment?
That was the core question. And how did the court interpret that awkward 1873 Act in this first go-around?
Well, the Supreme Court's ruling in United States v. Union Pacific was a pretty significant setback for the government's immediate efforts.
Okay.
The court interpreted the 1873 Act quite narrowly. They focused more on its procedural impact rather than any substantive change.
Procedural.
They basically ruled that the act did nothing more than provide the government and the companies with a procedure for enforcing their respective rights. Rights that already existed under the earlier laws, specifically the original 1864 law that set up the government loans in the first place.
So just a procedure for enforcement, not a fundamental change in the financial obligations themselves.
Exactly. And here's where it gets a bit technical, but it's crucial. The court found that while Section 1 of that 1873 Act allowed the government to withhold all the payments, it actually changed. Nothing about how much of that withheld money could legally be applied to the debt's interest. The original 1864 law had stipulated that only 1/2 of the money the government owed to the railroads could be used to pay interest on the bonds.
Only half, and only for interest.
Right. And the Supreme Court's decision in this Union Pacific case upheld that limitation.
So even if the government held on to all the money they owed the railroad for services, they were still legally restricted to using only half of that money to cover the interest on the debt. It couldn't touch the principal and couldn't even use the other half for interest.
Precisely. The court concluded that the 1873 Act did not change substantive rights of the parties. It didn't alter the core financial deal or really increase the government's power to apply funds directly to the full debt, especially not the principal.
Wow. So that decision, hinging on a really technical reading of how the new law interacted with the old one, it ended up being a victory for the Union Pacific.
It did.
And it meant the government's first big attempt to use withholding as leverage against this whole debt problem was severely limited.
Right. It reinforces that idea that these early legal challenges were kind of sidestepping or at least failing to address the deeper financial instability caused by all that Credit Mobilier siphoning.
The core problem, the potential default on the main government loans, that just remained unaddressed.
Okay, so the first legislative attempt was awkward. The first major court case interpreted it narrowly. The core problem of unpaid debt and shaky railroad finances is still there. What was the next step in this escalating struggle?
Well, with the debt problem clearly persisting, the sources note that over $16 million of the original $24 million loaned under that 1864 law was still unpaid.
Wow, that's a lot.
It is, and concerns were continuing that the railroads were just paying out too much in dividends and insider profits instead of actually saving for repayment. So Congress tried a more direct approach this time.
Okay.
This led to the Pacific Railroad Sinking Fund Act of 1878. It's popularly known as the Thurman Act, after its sponsor, Senator Allen G. Thurman.
The Thurman Act. And this act introduced the concept of a sinking fund. What did that actually involve?
So the core idea behind the Thurman Act was to mandate to force that a portion of the money the government owed the railroads for services, like mail delivery, troop transport.
Right, the money they were already withholding half of for interest.
Exactly. That money wouldn't just be paid out to the companies anymore. Instead, a significant portion of it, plus a percentage of the railroad's net earnings, will be put into a designated public trust fund, a sinking fund.
Okay, a forced savings account, essentially.
That's a good way to put it. Senator Thurman's explicit intention, as the sources outline, was to amend the original 1864 Act's provisions. He wanted all of the railroad's earnings from government services, not just half for interest, plus that extra percentage of net earnings, to go towards the secure payment of the debt.
Both principal and interest this time.
Both principal and interest. This was a clear legislative effort to force the railroads to set aside funds specifically for repaying the government loans. It aimed to circumvent the limitation that the Supreme Court had established in that earlier Union Pacific case.
This sounds like a much more aggressive, much more direct move by the government. They were really trying to ensure they got their money back. It's like they were saying, okay, if you won't save for this debt, we are going to save for you.
Precisely. It was a clear attempt to impose financial discipline on the railroads, specifically to protect the public investment. Now, interestingly, the railroad leaders, they weren't entirely against the concept of a sinking fund, at least not in theory.
Oh.
The sources mention Collis Huntington, who was a major figure at the Central Pacific. He even proposed an alternative plan that involved extending the debt repayment period, but coupled it with a sinking fund. So the idea itself wasn't totally alien.
Okay.
However, when the Thurman Act passed in its specific form, mandating exactly how their money, their earnings, would be handled by the government.
They weren't so keen then.
No. They immediately initiated lawsuits to challenge it. They saw this as an unconstitutional interference, an infringement on their corporate property rights and their contractual rights under the original government agreements.
Which takes us back to the Supreme Court again.
Back again.
And this wasn't just one lawsuit this time, was it?
No, the challenges came from both of the major Pacific railroads. Lawsuits were filed by a shareholder of the Central Pacific, a guy named Albert Gallatin, though he was often seen as acting in the company's interest, and by the Union Pacific itself.
Okay.
These cases were combined because they raised very similar fundamental questions about the constitutionality of the Thurman Act. Could the government just impose this sinking fund? Did it violate the railroad's rights? They were heard together and became famously known as the sinking fund cases at the Supreme Court in 1879.
This really feels like the main event then, the ultimate legal showdown stemming from all the Credit Mobilier fallout and this massive debt crisis. How did the court rule this time around?
The sinking fund case's ruling in 1879 was absolutely a landmark decision. And this time, the Supreme Court upheld the constitutionality of the Thurman Act.
They upheld it, so the government won this round.
They did. This represented a significant shift from that more technical, narrow ruling in the Union Pacific case just 4 years earlier. This time, the court sided with the government's power to impose this sinking fund requirement.
Okay, who wrote the opinion? What was the reasoning?
Chief Justice Morrison Waite wrote the majority opinion. And his reasoning, it really provides deep insight into the legal thinking of that era regarding corporations and government power. It's quite fascinating.
So what was the crux of Waite's argument for upholding the act? How did he get around the railroad's claims that it violated their fundamental rights?
Well, Waite's opinion is actually quite carefully balanced. He started by acknowledging that, yes, the government couldn't just interfere with private rights arbitrarily. He stated very clearly, the United States cannot any more than a state interfere with private rights except for legitimate governmental purposes. Now, the Constitution's contract clause, which limits states, didn't directly apply to the federal government here in the same way, but Waite was implying a similar principle. Government actions have to serve a legitimate public purpose. They can't just be arbitrary takings of property.
Right. So how did he justify the Thurman Act then?
His justification rested heavily on the unique nature of the Union Pacific and Central Pacific railroads. He didn't outright reject the railroad's constitutional theories about property rights, but he essentially distinguished their specific situation.
How were they unique?
He characterized these railroads not merely as private corporations operating independently, but as creatures of the United States. They were specifically created by acts of Congress for public purposes.
Namely, building the Transcontinental Railroad.
Exactly. Building this vital piece of national infrastructure.
So the fact that they were created by the government for a specific public mission gave the government more regulatory power over them than, say, over a purely private company.
That was precisely Waite's argument. He described the corporation itself, not just its assets, but the entity, as a peculiar species of property, which is subject to legislative control so far as its business affects the public interest.
Peculiar species of property. That's a striking phrase.
It really is. He's saying a corporation isn't just like a piece of land or an individual's bank account. It's a distinct legal entity created by law.
Yeah.
And because its business directly impacts the public interest in this case, national transportation, and critically, the government's own financial stake, it's legitimately subject to greater legislative control.
And he even made a distinction that sort of weighs into that whole corporate personhood debate that was starting to brew, didn't he?
Yes, he did. Implicitly, at least, he pushed back against the idea that a corporation is simply equivalent to a person. He noted, quite pointedly, that a corporation is not sentient. It does not have a mind, contrasting it directly with a human being.
Interesting.
So the analysis here is that Waite's majority opinion, while it upheld the government's power to mandate the sinking fund, it did so by carving out this specific category: government-created corporations serving a clear public purpose. He argued the regulation was justified because it served that public interest, ensuring financial stability to repay public debt, and because the entity being regulated wasn't a natural person, but a legislative creation.
So it sort of expanded the conventional legal understanding of the government-corporation relationship, suggesting more latitude when public purpose and creation are involved.
Exactly. It suggested that the government had more power to amend the terms of its relationship with these entities it had created for public ends.
Okay, so the majority upheld the government's power based on this unique status of the railroads. But I know there was a very strong disagreement on the court, particularly from Justice Stephen Field. What was the core of his dissent?
Oh, Justice Field issued a vigorous dissent. He was known for his staunch defense of private property rights and generally a laissez-faire approach to economics.
Right.
And he argued forcefully that the Thurman Act did violate fundamental rights. Specifically, he saw it as violating the principle of taking private property without due process of law, even if that property belonged to a corporation. He viewed the mandated sinking fund as an unjustifiable, unconstitutional interference with the railroad company's finances and their existing contracts.
So he saw the government forcing them to put money aside as essentially a seizure, or at least an unconstitutional control of their assets.
Yes, that's exactly how he framed it. And his argument was rooted in this principle he held very strongly, that the law must apply equally. It should protect property rights for everyone, regardless of their status or their wealth. As quoted in the source, his core principle was, "The law that protects the wealth of the most powerful protects also the earnings of the most humble, and the law that would confiscate the property of the one would take the earnings of the other."
That's a powerful statement about the rule of law and equal protection under it. But how did that principle apply specifically to these railroads, which were, massive, powerful corporations?
Well, this is where Field's dissent directly engaged with that burgeoning debate over corporate personhood.
Right.
The source highlights that Field explicitly stated that for him, it did not matter that the powerful were corporations. Their rights were the same as those of individuals.
Wow. So a direct counterpoint to Chief Justice Waite's view of them as a peculiar species of property.
A very direct counterpoint. Field believed that under the Constitution, a corporation, because it's a legal entity capable of holding property and entering into contracts, should possess the same fundamental rights as an individual person. That included the right to due process and protection against government interference with its property and contracts. He saw the Thurman Act as violating those rights.
So the sinking fund cases really became a battleground over this fundamental question. Are corporations primarily legal creations subject to significant regulation for the public good, especially when created by the government? Or are they essentially persons under the law possessing the same inherent rights as individuals, which would severely limit the government's power to interfere?
Absolutely. The source frames the entire Credit Mobilier incident and these subsequent legal battles, particularly the sinking fund cases, as being deeply embedded in a much broader struggle, a struggle about the nature and status of corporations and other large business concerns in American society and law, and also about the growing influence of big business on politics itself.
So it wasn't just about getting the railroad debt repaid.
No, far from it. It was a foundational conflict over who really held power in a rapidly industrializing nation. Should the government have the power to regulate these powerful corporations in the best interests of the community, as reformers were arguing?
Yeah.
Or did the Constitution limit the degree to which government could interfere with business practices, as the railroad leaders and their legal allies, like Justice Field, contended?
Yeah.
The sinking fund cases really captured this struggle for control right there at the highest level of the judiciary.
It's incredible how one major scandal, starting with insider dealing during construction, could force the Supreme Court to confront these massive fundamental questions about corporate identity, government power, and the public interest.
It really is. And the outcomes of these cases, the arguments made within them, they had ripple effects far beyond just railroad debt repayment.
Yeah, how so?
Well, if we connect this back to some other sources we've looked at, maybe about the relationship between political campaigns and the court, or the idea that the judiciary is unavoidably political, not partisan, but political in the sense that its decisions affect the allocation of power and the content of public policy.
Right.
The sinking fund cases are a prime early example of that. The justices weren't campaigning politicians, obviously, but their rulings directly shaped the legal boundaries of corporate power and the government's ability to regulate it. And this was happening during an era when industrial wealth was consolidating at an unprecedented rate.
They were drawing lines where maybe none had really existed before.
Exactly. Fundamentally impacting the balance of power in American society.
So it wasn't partisan politics in the way we think of it now, but it was deeply political in the sense of shaping the economic and social landscape.
Absolutely.
And you mentioned connections to other legal areas like antitrust law.
Right. If you look at the source material discussing Justice Holmes, particularly his views on antitrust and his famous dissent in cases like Northern Securities, which incidentally also involved railroad trusts, you see a related thread.
Okay.
It's still the court defining the limits of government power over big business, but often through a different legal lens like the Commerce Clause. While the sinking fund cases were really focused on that specific relationship between government-created entities, public purpose, and debt repayment, Holmes, a bit later, was grappling with how far the government could go in regulating monopolies and combinations in interstate commerce more broadly. His concern in the Northern Securities dissent was actually quite different from Field's in the sinking fund dissent. Holmes worried about the court drawing arbitrary lines that might paradoxically undermine society's structure by preventing necessary economic organization.
Whereas Field worried about the government interfering with existing property and contractual structures.
Precisely. But both sets of cases, happening relatively close in time, represent the legal system wrestling with the unprecedented scale and power of these Gilded Age corporations. They were trying to figure out the appropriate level, the appropriate nature of government intervention.
So the Credit Mobilier scandal and the battles over railroad debt repayment were really like the opening salvos in this much longer legal and political drama about corporations and government power.
I think that's a great way to put it. It forced a rapid and often contentious evolution in American law just to begin addressing the realities of massive corporate power.
The old laws, designed for simpler times, were just inadequate.
Completely inadequate for the scale and complexity of the railroad empires, and certainly for novel financial schemes like Credit Mobilier. The legal system was absolutely playing catch-up.
Okay, so as we wrap up this deep dive, thinking about everything we've discussed, what are the most critical lessons or takeaways from the Credit Mobilier scandal and these subsequent legal battles, really based on the sources we've explored?
Well, based on the sources, I think there are several key insights that stand out. First, the Credit Mobilier scandal itself is just this powerful historical illustration. It shows how massive government-backed projects can become incredibly susceptible to corruption and insider enrichment.
Especially when oversight is weak.
Exactly. Especially when oversight is weak and the legal frameworks just haven't evolved yet to keep pace with new forms of financial manipulation and complex corporate structures. The deliberate secrecy of Credit Mobilier really exploited those gaps in the law and in public awareness at the time.
Okay, that's one. What else?
Second, the legal battles that followed, from that initial quite limited ruling in United States v. Union Pacific to the really landmark sinking fund cases. They clearly show these foundational struggles in the U.S. to define the relationship between powerful corporations and the government. These cases forced the country, and especially the courts, to confront how to balance fostering economic development, which everyone wanted, with protecting the public interest, especially when those interests seemed to diverge so dramatically as they did here.
And the courts were right in the thick of that balancing act.
Absolutely central to it. Which leads to the third point. The Supreme Court's deliberations, particularly that sharp divide in the sinking fund cases between Chief Justice Waite and Justice Field.
Right, the peculiar species versus same rights debate.
Exactly. That highlights these fundamental questions being debated about the very nature of corporations and their legal status relative to individuals. Were they artificial entities created by law and therefore subject to the significant regulation for the public good, or did they possess rights essentially akin to persons, which would limit government interference? This debate over corporate personhood, which was sparked so prominently here, is one that continues to echo through American legal and political discourse even today.
Still relevant.
Very much so. And finally, I think the sources really underline that the tension between those advocating for robust government regulation to serve the public good and those emphasizing constitutional limitations on government interference with business, this wasn't just some academic discussion back then.
Yeah, it had real consequences.
It's a defining struggle of the Gilded Age. It directly shaped legislation, court decisions, and the whole trajectory of American capitalism. And you can still see the implications, the echoes, in debates we have today about corporate power, regulation, and the proper role of government in the economy.
It's truly remarkable how these historical episodes, rooted in this scandal from over a century ago, ended up establishing precedents and framing debates that still feel incredibly relevant now.
History doesn't repeat, but it certainly rhymes, as they say.
It does. And thinking about how a scheme like Credit Mobilier could thrive initially, basically because the legal and regulatory systems just hadn't anticipated anything like it, it makes you wonder. What does this historical example teach us about the ongoing need for vigilance, for adaptation in our legal and regulatory framework?
That's the big question, isn't it?
Yeah. As new industries emerge, new technologies create entirely novel business models. Economic power continues to concentrate in new ways. How can societies ensure their laws, their oversight mechanisms, evolve quickly enough? Quickly enough to prevent similar scenarios of, unchecked insider enrichment or potential harm to the public interest. It really seems like the challenge of keeping law in step with evolving economic power is just a constant one.
It's a challenge that the Credit Mobilier saga certainly reminds us is deeply embedded in the American experience. And yeah, the struggle definitely continues.
Indeed. Well, this has been a truly deep and I think really insightful dive into a pivotal moment in American history and law. Thank you so much for guiding us through these complex sources and revealing all the layers of this fascinating story.
My pleasure. It's a history that's definitely rich with lessons for the present.
Absolutely. And thank you, all of you, for joining us for this deep dive. We'll be back soon with another exploration from the source stack.